5 stocks I'm buying this August. Let's get into it, friends. And if you like these types of videos, smash that like button, hit the subscribe button, and let's get rolling. First up, number 1, Oscar Health. Of course, I'm going to mention Oscar Health. They're disrupting the health insurance or the dinosaur legacy health insurance industry. They are disrupting it with AI. They have a amazing CEO, Mark Bertolini, who used to be the CEO of Aetna. They're increasingly getting closer and closer and actually flipping to net income positive. They're taking a year off from that due to some things we talked about in a separate video. If you want to go check out my other Oscar videos, go check those out on my YouTube channel. I'll link them in the description below. And they are becoming a free cash flow juggernaut. This is a small $3.6 billion market cap. And again, I've talked about this company over and over and over again, but I believe they can grow 20 to 30% over the next 10 years and massively disrupt the health insurance industry. If we look over here at my high five snapshot, you see that with conservative assumptions, you get a $42 fair value, currently sitting at $14.34, a 66% margin of safety from today. I think anything under $20 or $20 to $25, which is 40% margin of safety, you just continue to dollar cost average into this name for the long term until you have the position built that you feel most comfortable with. And then you just sit back, relax, and you watch Oscar go on this massive run over the next 2, 5, and 10 years. Number 2, DLocal, like DLocal. This is DLocal. So this company is basically in the emerging markets sector. They are a finance company, and basically we have our SWOT analysis down here. We have market dominance, operates in over 40 countries with 900 local payment methods, scalable assets, light model, strong profitability metrics, strategic acquisitions. They just acquired a Kenya-based AZA finance. And basically what they do is they are a massive middleman between multiple countries across the world and basically in the emerging markets. And they are a middleman between companies doing business or customers getting access to other websites, other consumer products, essentially. We roll over here to visual stocks and we punch in DLocal. We can see that they're currently a $3 billion market cap. They have a $10.36 price at this time. They have revenue growth of 18%, profit improvement of 1,190%, profit growth year over year of 150%, a PE of 21, price to sales ratio of 3.8. You can just see transaction payment volume continuing to climb quarterly, net revenue retention continuing to decline, revenue continuing to incline, net income continuing to increase here on the quarterlies, and their free cash flow. They had one big bad dip in Q4. They came back, snapped back in Q1, and I think they're going to continue to grow that free cash flow. Way more bonds and cash equivalents than they do debt. I mean, this company just looks amazing. If we look at a yearly chart, total payment revenues going up, net revenue retention, revenues going up, cash flow going up besides last year. I think that was a one-off due to a lot of headwinds and fees, transferring of money. Net income had a down year, but I think they snapped back, get back up to a really good year. If we look at the estimates here, you can see revenue is expected to continue to rise. EPS is supposed to get back on track, and so is EBIT estimate. As we can see on the yearly chart, revenue continue to climb, EPS estimate, EBIT continue to climb as well. Overall sentiment on this name, bearish on the news, analyst sentiments slightly bullish, and then earnings call sentiment is very bullish. Again, if we look at my high five snapshot, we have a $19 fair value for this name, 16% annual CAGR over the next 10 years. And based on the fair value on EPS, we have an $18.36 fair value. So we're right about $18 to $19 fair value on this name, currently sitting at $10.36. Earnings are coming up next week. This week. So we should see how they perform. I think they're going to have a stellar earnings, and I think they're going to blow it out of the water. And you're going to see a massive spike in this name, is my guess. But we will see. I'm buying this name anything under $20, really anything under $15, I would say. Dollar cost average DCA into this name, sub $15. Third on our list is going to be Onto Innovation. Onto Innovation is a high margin, cash rich semiconductor tool maker poised to benefit from AI, EVs, advanced package trends, and just this entire AI sector and AI arms race that we're seeing. They're going to benefit from all of that. And advanced package trends, undervalued with strong growth, elite clients, and deep IP moat. They're a small guy, $4.4 billion market cap, and they compete with the likes of ASML and AMAT. So they compete with two large Goliaths in this sector. I think there's plenty of room for growth in this sector, and they're massively undervalued. We can see that we have a fair value on this name with conservative assumptions of $176 per share, a 49% margin of safety, meaning current price or fair value is 176 and down 49% margin of safety all the way down to current price of around $90 per share, would get you a 16% margin or annual CAGR, compound annual growth rate. And then EPS is also a buy here today with $189 fair value for 2025. So based on EPS, based on discounted cash flow, it's should be sitting around $175 to $190 fair value, a double from where we are today, sitting at around only $90 per share. So a massive opportunity in this name as well. Also, like I said, $4.4 billion market cap. Some strengths: technological leadership, strong financials, fundamentals, global customer base, TSMC and Samsung partnerships, which is huge, massive players in this field in chip making. Weaknesses: smaller scale versus competitors, AMAT and Lam and ASML. Operational complexity exposure, advanced packaging boom, emerging markets expansion, M&A and strategic partnerships as opportunities. And then threats: intense competition from KLA, ASML, AMAT, Lam. Research, supply chain disruptions, rapid. I think this is also a buy. I'm buying into this name. I think dollar cost average, anything really under $100 per share, you're getting 40% margin of safety or better on conservative assumptions. And I think that is something I'm going to continue to buy in August and the months to come, just for that reason that we are so undervalued. And I think this is a company that can do very, very well in this sector. If we look at yearly, revenues are continuing to climb. Had a bit of a down year in 2023, climbing back in 2024, and we're actually estimated to continue to climb back higher in 2025, 2026, and 2027. EPS is expected to continue to climb. And what else do you want to see? You want to see EPS climbing. You want to see net income climbing. You want to see free cash flow climbing. You're getting it all. Net income, free cash flow, revenues, they're all climbing higher, Meanwhile, they have about almost $1 billion in cash and cash equivalents and only $10,000. This company looks amazing. If we scroll down here, they have massive institutional ownership of 98.18% and only a sliver 1.1% of retail ownership and 0.72% of insider ownership. See BlackRock, Vanguard, JP Morgan, State Street, Invesco. These are the biggest institutional owners of Onto Innovation. If we look at the ratios here, you have a price to sale, or if we can just look at it on this last chart, price to sales ratio of only 4.3, price to booking of 2.34, forward PE of 19 and 20 PE ratio right now. Gross margins massive, 51%. Return on invested income, 11.32%. Any way you look at it, guys, this company is part of the AI race. They're part of AI, and they're going to be a big beneficiary selling the picks and shovels, which are the semiconductors that will make AI greater. It is a small cap company, and they are disrupting and trying to attack the larger companies, steal market share away. And I think they're doing a great job at that. I think there's enough room for all in here. Sentiment: bearish on news. Analyst is semi-bullish, and then your earnings call sentiment semi-bullish. Neutral on X, hasn't really hit X that big yet. Bullish on stock twits, I guess. We will see what happens with this name, but I am a buyer here. Again, DCAing. Number 4, this is not a smaller cap company. This is a bigger blue chip company, but UnitedHealth Group. This is the largest health insurance company in the world. They've had a very strong rough patch recently, but I believe that this company is now so undervalued that you cannot turn away and not get a piece. I've run conservative assumptions in my high five snapshot here. By the way, if you want access to that high five snapshot, my full library of over 100 stocks in here to give you a quick high five little snapshot of the company, their fundamentals, and whether they're a buy, sell, or hold. You can have access to this joining the high five community. I'll link it in the description. Also, drop a like, drop a subscribe if you're enjoying this content, enjoying these top 5 stocks that I'm buying in August. I am a buyer of UNH here. Anything under $285 per share. I think you're getting a great deal, getting 30%, 40% currently, sitting at $245 per share, getting 40% margin of safety. When you have an intrinsic value based on a discounted cash flow model with very conservative assumptions, you are sitting here looking at a stock that should be priced today at $408 per share. But what do we know? When sentiment gets really bad, when things start to really domino effect on a company, and investigation here, CEO tragically being murdered there, constant rotation in leadership, you're going to get a stock tariff stuff, which doesn't really affect them, but like ACA subsidies and health insurance, like just being weaker as a sector, medical loss ratios spiking in that sector. Yeah, when you get all these things, you get a perfect storm, and you're going to see stocks like this just completely crater. We have a $630 52-week high, and now we had a 52-week low of $234. Now we're sitting right around $246. We are severely undervalued in this company. I can't say it enough. You're getting 11% free cash flow yield. You're buying this company at a 9 current PE. You're getting a company that does $25 billion in free cash flow this year. You're getting a company that's going to consistently grow 4 to 8% over the next 10 years consistently without even blinking an eye. They're also getting into Optum, or they have this Optum, which is good, basically an all-in-one platform for people to get the healthcare that they need. They are technologically advanced in getting into that realm. And yeah, this is a company that it's a boring company, but man, when the fundamentals are this outstretched from reality, it's a buy all day. 12 to 13% annual CAGR you'll get if these assumptions are correct. 12 to 13% annual CAGR for the discounted cash flow model, and then for the EPS, it's a 16%, $1,115 or $802. Let's just call it $1,000 per share, $900 to $1,000 per share. It's fair value in 10 years time, currently sitting at $245. I am buying this name anything under really $300, $285. The more margin of the safety, the better with these names. I don't know what else to say about UnitedHealth Group. UNH is a healthcare compounder with unmatched scale and pricing power. Its Optum division touches 100 million lives, and its integration creates high switching costs and durable margins, all at a value multiple. That is the bull thesis for this company. You have strengths, weaknesses, threats down here. You guys can read that. We go here to visual stocks in UnitedHealth Group. We can see that a bunch of things are all crazy, but let's just look at the yearly. UnitedHealth revenue up and up and up. Total Optum revenue up and up and up. Total individuals served continue to climb. Total revenue climbing. Net income dipping down a little bit with some headwinds, but I think we'll get back on track. Free cash flow running higher, dipping down a little bit, but I think it's back on track. I don't think this is actually accurate. Shares outstanding, they're buying back shares aggressively since 2006. They also pay a really nice dividend on this name. Institutional ownership with only 9% of it being retail right now. Big names like Vanguard, BlackRock, State Street, JP Morgan buying this company. A 3.6% dividend on this name. So sit back while you wait for this name to get turned around and collect a nice dividend. Revenue estimates are supposed to continue to climb over the years. And EPS, like I said, is supposed to get back on track after a down year here in 2025, getting back on track. Number 5, our last stock, Zeta. Zeta reported earnings. I was calling out this name as I did all these other names inside the High Five community, on X, here on YouTube. I give out so many names for free. tell you guys when I see it. I tell you guys when I find it. I give you my bull thesis. It's up to you to do your own research at that point. We can just look at this for a second. How about a 27% day? They had earnings. They crushed, double beat, raised guidance, raising free cash flow, raising EPS, raising net income, raising revenue, all of it for this year. And they just absolutely were up 3% after they reported, and then 7%, 10%, then back down to 7 or 8%. I was buying in after hours after they reported, and then they just exploded. They just exploded 27% higher because I guess people finally realized, oh, wow, they just demolished earnings. Oh, wait, they're very undervalued. Oh, wait, this is a $30 stock, and they're sitting at below $20. They were sitting at a low of $10.69 as a 52-week low. They're a $30 stock. You're still getting a 32% margin of safety today from where the stock should be at. And these are conservative assumptions. I think they could be growing 20% plus revenue growth over the next 10 years. I think they can increase free cash flow margin rates. And I think they can just overall continue to crush it like they've been doing. And they could be a $30, $40, $50 stock here in the next couple years. Now, if you don't know what Zeta Holdings does, I just did a video on this. I just did a earnings review on this, and you can look at that, watch that video, and see all my insights, all my knowledge, all of my information on why I love this company so much. Zeta is basically taking AI, combining it with all their tools that they have for marketing, and they are the one-stop shop for ad marketing, political marketing, you name it, they got it. Vehicle sector, they do healthcare, they do politics, they do sports, they do all of it. Their platform's amazing. Their what they offer clients and customers and businesses, amazing. How they build their ads for their customers, it's just a phenomenal company. AI-driven platform, consistent outperformance, enterprise client growth, weaknesses, competitive pressure, dependence on larger clients. But they're expanding those larger clients, so just so you know, and they're expanding their smaller clients as well. Brand visibility, which I don't know anybody that doesn't know them in the business world. AI expansion, strategic acquisition of live intent, undervalued snapshot, and macroeconomic headwinds, data privacy regulations, political revenue, volatility. That's the 5, guys. Oscar, DLocal, Onto, UnitedHealth, and Zeta. Those are the 5 companies I'm buying. Those are the 5 companies I'm buying in August. I'm going to continue to dollar cost average in those names, continue to sell cash secured puts to put money in my pocket so I can buy more shares later down the road. And I'm going to continue to post all of that in my community. Again, if you want to be part of that community, the High Five community, link will be in the description below or the first comment below this video. And if you haven't yet, hit that like button, hit the subscribe, and I will catch you all in the next video. Have a great and amazing day.